Keith Weiner, CEO of Monetary Metals. Last week in this video series, we talked about the fact that the dollar is irredeemable, and one implication of this, which is that debt is rising exponentially throughout the system. Today, we want to take a look at a different implication of this, which comes from the fact that the dollar is a closed-loop system, and we're going to think about the rate of interest today. So to understand this, let's compare and contrast pre-1933, when the dollar was actually redeemable in gold, to today when, of course, the dollar is irredeemable. Before 1933, if the banks or the government lowered the rate of interest, the saver had control. If the saver decided that 0.25% interest rate was not worth the risk of loss and the time of locking up his money, he can go to the bank. He wasn't buying gold. He would take his $20 bill and redeem it for 1 ounce of gold and go home and put it under the mattress. This forces the bank to sell a bond in order to come up with the gold to give to the customer. So I want to use this ruler as a visual aid to understand the bond market and how it affects the rate of interest. The rate of interest and the bond price are a seesaw or teeter-totter. If the bank is selling the bond in order to redeem the customer's gold, the rate of interest is mathematically tied in a rigid way that as the bond price is going down, the rate of interest is going up. So in this system, before 1933, the saver is actually in control. Today, of course, the dollar is not redeemable, but one can buy gold. The difference is that if you buy gold, that means someone used to own the gold, he's now using the gold to buy dollars. There's no effect on the bond market, no effect on the rate of interest. And the reason is, think of this now from the perspective of the person who had the gold, sells the gold, and now he has dollars. If he has $100, he can put those dollars in his pocket. If he has $100,000, he can put those dollars in the bank. If he has $100 million, he puts those dollars into the treasury bond market. The saver is now today disenfranchised. And the consequence of this can be seen in this chart of the 10-year bond interest rate. So as you can see on this chart, the rate of interest has been falling for 32 years. Changing tack slightly, let's take a look at how credit can be contracted in the system today and how it could contract pre-1933. Pre-1933, any saver had the right to redeem his dollar and get gold, as we said. And this is not a calamity. This is a controlled, ordinary, normal, reasonable contraction of credit, and the system is self-adjusting. Today, there is no self-adjustment mechanism. The only way that credit can contract is forcibly, and that is when a bond defaults, the bank is forced to write off the asset. This is a huge calamity, and the reason is the bank has liabilities to match its assets. If the bank has $1 million asset that goes bad, somewhere in the system, the bank is going to fail to make payment on or make good on a $1 million liability. And the problem is, what the bank calls a liability, somebody else calls an asset. If you think you own dollars, if you think that dollar is just simply money, the problem is the dollar is actually the liability of a bank somewhere. And so we see a trillion-ton force, which is credit wants to contract. There is so much bad debt that needs to be written off. And the Fed is fighting this with everything they have, trying to expand credit. And so I think of this as the trillion-ton force meets the trillion-ton force. The result right now is that we see a net transfer of assets, or I should say toxic assets, from private balance sheets to the Fed's balance sheet. So let's pull up a chart of the Fed's balance sheet and take a look at that. As you can see on this chart, the Fed has been obliged to onboard trillions and trillions of dollars worth of these bad assets. The reason is simple. The Fed is trying to continue the bank's ability to make good on their obligations. So in this view, the Fed is not trying to create a currency war. They're not thinking about employment. They're not thinking about the balance of trade with other countries. They're simply trying to prop up the system a little bit longer. Currency wars, therefore, may be a possible effect of this debasement of the dollar and not the cause. So we want to transition from here and think about the rate of interest. Where is the rate of interest going? So the conventional theory says that savers have an expectation of inflation, rising consumer prices, and nobody would want to own a bond that pays less than the rate of inflation. We'd like to offer a slightly different model. I'd like you to consider the following. That, as we said, the system is a closed-loop system. There's no way for assets to drain out of the system. However, there is actually a spigot in the form of the Fed, which can inject more dollars into the system. As this chart of the bond market and the interest rate shows, the bond price has been rising for 32 years. And the reason is that, obviously, more dollars have been flowing into bonds than other asset classes. That's what a falling interest rate means. And so, if you look at it this way, what's happening is everybody knows the Fed is buying bonds, and therefore the logical thing to do is to front-run the Fed and buy bonds ahead of them. And then other people simply know that everyone else is buying bonds, and so the entire system is organized around buying bonds, ultimately to dump them onto the Fed's bid. So, in this view, we think that the rate of interest, although it can have some ups and downs, recently the rate of interest has risen a little bit. The trend is not over. The falling rate of interest trend line is not broken yet. And so our advice to viewers would be very simple. Don't short the Treasury bond yet.